Thanks a lot, Corey. Good afternoon, everyone. My name is Alex Xethalis. I'm an Executive Vice President in the Wealth Management Distribution Group here at Strive, and I'm joined by my colleague, Chris Nicholson, who's a Senior Vice President in our Research Department. Today, we'll be talking about one of my favorite funds in the Strive lineup, Strive Natural Resources and Security ETF, ticker FTWO. And Chris, as you know, just last week, we changed the name of this fund to dispel any of the misconceptions around FANG 2.0. As we all know, FANG 1.0 is an homage to innovation and technology in this country, whereas our FANG 2.0 is a pure exposure to essential sectors such as fuel, aerospace, agriculture, nuclear, and gold. Today's going to be a really good time. I'm looking forward to hearing more about the fund. But before that, I would like to say a thank you. Last week, or this month, we hit our 2-year anniversary at Strive. And I want to say thank you to our customers, to our family, to our friends, and to our supporters across the country who've made the last 2 years possible. Strive at its core is a disruptor. We've challenged the status quo in the asset management industry. We've shown a light on corporate governance issues. We've allowed corporations to push back on the social and political agendas being foisted upon them by the stakeholder capitalist movement. And in a shameless nod to a great sales team, we've raised $1.6 billion across 13 funds in just 2 short years. None of this is possible without you, our clients, our family, our friends, and our supporters. So on behalf of myself, on behalf of Chris, and on behalf of Strive, I want to say thank you. Now, before we turn it over and start talking, I'd like to give an overview of Strive. Corey, could you move us to the next slide, please? Strive at its core, we're an asset manager with a corporate governance differentiator. We were founded to unapologetically promote American capitalism and to defend and provide air cover to corporations looking to push back on the social and political agendas being foisted upon them. At its core, Strive provides cover and defense against stakeholder capitalism. We push back, we enable this pushback using the arrows of the shareholder activist quiver. Think of proxy voting, public engagement, shareholder resolutions, and the bully pulpit. Corey, could you move to the next slide? We help corporations push back against things that will distract or destroy shareholder value. Lastly, we believe in engagement, not divestment. Our products provide pure beta exposure to asset classes you likely already own in your portfolios. We actually look to control for risk, return, and fee so that the differentiator, the reason why you own Strive, is to ensure that your values align with your asset manager's corporate governance exposure. Now, we've had an unprecedented level of success in our first 2 years, as noted. Most notably, of course, is in our corporate governance exposure. You can learn more about that by visiting strive.com and going to our corporate governance tab. Now, that's a quick overview on Strive, what we've done, who we are. I'd like to reintroduce my colleague, Chris, for those of you who are just joining. Chris is a Senior Vice President here, runs our research department at Strive. Chris, we have a really good agenda today, a lot of fun talking points about one of my favorite funds. Let's talk about some of the secular themes you're seeing that benefit essential sectors in FANG 2.0.
Great. Thanks, Alex. I'm Chris Nicholson, Senior Vice President of Research here at Strive Asset Management. Everybody here at Strive is pretty excited about FTWO, now renamed the Natural Resources and Security ETF. And we're going to go through each of the 5 sectors today and explain some of the major tailwinds they're experiencing, and in 1 or 2 cases, a headwind. And before we do that, I want to spotlight 2 of the secular trends that many of the FTWO sectors participate in. And then when we go throughout the 5 individual sectors, we'll touch on expanding some of the individual points about how they may participate in the trend of deglobalization, for instance. So deglobalization is a response to rising geopolitical risks from China, Russia, Iran, and North Korea, mostly. And these kinds of risks threaten all kinds of global supply chains. And so we see this especially in the energy sector. Russia is one of the world's dominant providers of oil and natural gas. And Europe in particular loves to buy Russian gas. And so when we go to the fuel sector and the nuclear sector, we'll see, for instance, how those two energy-related sectors benefit from the move away from relying on Russian fossil fuels. American producers step up to fill the void. And forces like that, participation in the deglobalization of the world, is something that a lot of these sectors are involved in. You can make the case for each of the 5 sectors to be involved in that. So that's one of the major F2 trends that we want to cover and introduce to people today. And the second major secular trend is artificial intelligence. And this is something that I'm particularly excited to talk about, because one of the things about F2 is that it doesn't have tech in it. Of its 5 sectors, none of them are technology. Yet, we see some behavior where it does, through certain stocks and sectors, participate in the same AI trade that tech stocks often benefit from. So when we walk through the particular sectors, in particular the nuclear sector, I'm going to explain how stocks like Constellation Energy are becoming part of the AI trade.
I love that. And, it does seem counterintuitive when we have conversations with advisors to think of this particular portfolio as benefiting from AI. But to your point, it absolutely does. Corey, can we go to the next slide? As a refresher, these are the 5 sectors that FANG 2.0 gives exposure to. We can talk about it a little bit more, but do you want to just cover the broad concepts here and maybe highlight the acronym that gets spelled out?
Sure. So we have we have it in the order where it shows you how the names and the sectors are kind of a relic of the original FANG name. And FANG stood for, Facebook, Apple, Alphabet, Amazon, Meta, Google, Google was the G.
Netflix and Google.
They've all changed around at various times. And now it's called the Mag 7 in its newest incarnation. So we have the FANG acronym. We'll go through these 5 sectors in order, starting with fuel. Like I just touched upon, fuel is one of the main deglobalization plays. Aerospace is really about grabbing the aerospace and defense sector, which is a straightforward portfolio hedge against geopolitical risks. We'll talk about agriculture, and we'll talk about some of the longer-term tailwinds the sector is experiencing, like an emerging middle class in emerging markets. And then we'll also talk specifically in the agriculture sector about some of the headwinds that the sector has been suffering from in the near and midterm. Then we'll touch on the nuclear sector, which is, for me, going to be my favorite, and it's going to be the highlight of the fund for me, really. I'm very proud of our nuclear sector in F2 and the way it's delivered already. And then finally, we'll finish up with gold, which really we could call gold and precious metals, because it turns out that there's more copper in the fund, growing at a faster rate than you might expect.
I agree. I don't think swapping out the G for the C will work for the acronym, but it's a great note. Corey, can we go to the next slide, please? Right, so here we have our fuel sector. Why don't you give us an overview, talk to us about this projected oil demand and what it means for this fund?
Sure. So this chart up here is one that we had to do a lot of research to construct, because it's a very important chart in Strive's opinion, but it's not a chart that exists anywhere else that we've seen. You can't just Google it and find this chart showing you this particular situation, where it's showing you that there is such a dramatic divergence between major agencies and companies' projections for global oil demand. And what this comes down to is the ESG movement, Alex, and in particular, the part that is strongly pushing to achieve the Paris Accords net zero emissions reductions targets, meaning they want to achieve net zero emissions by the year 2050. And so that's why this chart ends at the year 2050 with various agencies' oil demand projections. So you look at them, and one thing that jumps out right away, you look at the bottom, the agency, the company that's calling for oil demand to project to decline from 100 million barrels per day to, around 80, a steep plummet, and it's BP calling for that. And then just above it, you have Bloomberg. Now, in the middle, two that are calling for flat oil demand are Exxon, kind of a surprise for Exxon to be, not particularly bullish on oil, and the IEA, the International Energy Agency. You can see OPEC is not far off from those. Even OPEC seems to be throwing in the towel on oil demand at times. And then you see the outlier, the green line, the EIA, the Energy Information Agency. This is the United States official, energy analyst, basically. This is what they do. And Strive's view on oil demand is much closer to the EIA's view of upward oil demand, much closer to that view than anyone else's. So Alex, the reason I want to dwell so much on this particular chart is to show you how unusual this is. What we have is a divergence in the market between the market participants who think that the Paris Accords will be achieved and those who don't. If you believe that the Paris Accords net zero targets will be achieved on schedule, then to make that true, oil demand has to go on the path that Bloomberg and BP show, with it dropping steeply. If, on the other hand, you just kind of step back and you focus not on what you want to happen, but what you think will happen, then you may end up with a point of view like the EIA has or like Strive has, where we look at the world. We see EV adoption slowing. We see renewables still costly and unreliable. We see battery technology still too expensive. We see fossil fuels still very cheap and reliable. And so we look at that situation. We look at the emerging global middle class that we're going to talk about in the agriculture sector. As nations industrialize, they need more energy. As AI explodes, AI guzzles more and more electricity. And so Strive looks at the world, and we just see rising energy demand. And that's why we agree with the EIA, the green line, increasing demand forecast, whereas everybody else kind of starts with the premise of assuming that the Paris Accords net zero targets will be achieved, and then kind of reverse engineering the projected oil decline you would need for that to happen. So that's the fundamental difference in the approaches that market participants are taking. So because you have this extreme divergence, you have, if you're an oil bull, a potentially outsized reward with potentially a compelling opportunity. Because the thing is that based on the fact that most market participants are assuming in some level of net zero achievement and lower oil demand, we are not exploring for reserves at the same rate that we used to. We're not spending the money. We don't have the reserves lined up. We're not lining up more because we don't expect to need them. So if we go out to the point where these disagreements really start kicking in, 5 years or so. And in fact, I think that the situation will be accelerated because of increasing AI energy demand. When that happens, it's going to turn out that all of a sudden we'll be hit by undersupply because everybody else, or at least a large part of the market, has been assuming, BP's picture. BP has been investing, Exxon has been investing and exploring for reserves based on this picture about how little we'll need those reserves in the future. That's why if the bulls like the EIA, the green line, are right, we will be hit by massive undersupply of oil.
And that is a great catalyst for the F in FANG 2.0, the fuel sector. I often hear advisors ask, how do you feel that the stakeholder capitalist movement, the politicized ESG movement, impacts companies? And I think one of the ways to think about it is, at best, it's a distraction. At worst, it's value destructive. There is no single sector that has been destroyed as much by this movement than energy. It led Strive to launch our first fund, Drill, the U.S. Energy ETF. And I think this is a great example of that. Thanks so much, Chris. Corey, can we go to the next slide, please? All right, aerospace and defense. So how does this sector play in as an essential sector in the FANG 2.0?
So the defense sector is really the one that's most straightforwardly tied to the theme of deglobalization. I mean, if what you're worried about, it doesn't take a rocket scientist. If what you're worried about is China and its military threat to Taiwan, if what you're worried about is Russia and its military threat to many of its neighbors, don't outthink yourself. The defense sector is the logical way to address some of these portfolio risks. It is also true that in cases of geopolitical conflict, oil prices tend to rise. So that plays a role as well. Now, in the defense sector, I put this chart up here because I think this chart really tells a compelling story on its own. And what you can see here is just U.S. defense spending as a percent of GDP. People say that we spend a lot on defense, and we do relative to the rest of the world, and we do in nominal terms. But when you look at it as a percent of our GDP, our defense spending is so much lower today than it has been for basically almost every point over the last 70 years. I mean, and what this chart shows you is that the defense spending, it spikes precipitously during times of geopolitical conflict. South Korea, we're spending 11% of GDP on defense. Vietnam spending 8.6. During the Cold War, the height of it, spending 5.7. Afghanistan, Iraq, spending 4.5%. And then we kind of have this steady decline, especially after the end of the Cold War. We have a decline in defense spending. Now down below 3%. And what this chart is telling you is that if you're worried about geopolitical risk, particularly from China, historically, there is a lot of room for that defense spending to go up toward its historical average. And if there is actual rising geopolitical tension, then we would expect that to have a spike like it has at every time in the past. And so you just look at that, if you just ballparked it to do some napkin math, you might figure that kind of a historical average is around 6% there as a percent of GDP. It's 3% now. So by that reasoning, over the span of several years, if we had a great need to, we would have room to, in a sense, double the amount of money we spend on defense. So that's the major point that chart is making. And I guess what I would couple it with, unfortunately, is the fact that defense is a zero-sum game. And because China is spending so much so effectively on its own defense, the United States is kind of mandated to either maintain deterrence by keeping pace with China militarily, or don't spend more on defense and raise the risk of conflict.
Absolutely. And obviously, given the structure of the FANG 2.0 ETF, all of those conflicts will be net benefits to the stocks in the aerospace and defense fleet. Corey, let's go on to the next. All right, agriculture. Now, agriculture has been a bit of a laggard in the fund so far since its inception. But why don't we talk about some of the short-term pickups and some of the long-term bull thesis?
Sure. So there's no cherry coating it. You can just pull up Deere's stock chart and say, this is not a stock that has done that well over the last year or so. Although it did have a good earnings report a couple days ago that I've been meaning to review. So Deere, it's not Deere specific. It's really the agriculture sector as a whole that has struggled. It's just mostly been reflected in F2 because Deere has a gigantic market cap, making it one of F2's larger holdings. So let me sum up maybe a couple of the headwinds facing the sector and Deere in particular. First of all, wheat prices and corn prices have dropped. They spiked a couple of years ago when Russia invaded Ukraine. A lot of the world's grain comes through the Ukrainian bread basket. Russia supplies a fair amount of agricultural goods as well. And so it was really the war that caused those things to spike, those commodities. And as they have descended sharply from that spike, farmers have paid the price. The boom is over. from that. A couple other things that are going against the agriculture sector. I mean, there's really a bunch of them. But one of the more interesting ones is that its ethanol catalyst is losing steam. This is something that many investors may not have heard of. Why has the agriculture sector been doing well over the last 5-10 years? Well, I've seen some analysis from Hedgeye that I found pretty convincing, saying that a lot of it was caused by government ethanol mandates. And this is, again, about net zero emissions and about the ESG movement. Fuel, viewed as a polluter, and so ethanol, cleaner. And so the government put in mandates saying, you know, we want 10% of this gasoline blend to be ethanol or something like that. And ethanol is often made from corn. So it turns out that these ethanol fuel mandates were a major tailwind for the agricultural sector. And now we have electric vehicles taking off. Every Tesla that gets sold means there's less ethanol demand and therefore less corn demand. So this is kind of a longer term tailwind that has been lifting the agriculture sector, is kind of running out of steam. And then there are various other problems, but let me mention one more: high interest rates. You know, in this one I'll mention because it hurts deer in particular. You know, farmers, they might have to take on a loan, or they might want to take on a loan, maybe lease some of Deere's equipment, and straightforwardly, high interest rates hurt what Deere is trying to sell to people. They hurt the purchasing power. And so those are some of the major reasons why the sector has been struggling over the last year or so.
But I would like to note that this fund splits all of these 5 sectors equally. So you're getting a level of diversification. When one sector does well, it's likely to come at the cost or, you know, have offset poor performance in another. It's one of the reasons why we really like the FANG 2.0. Let's go to the next letter here, N for nuclear.
So the nuclear sector, this is the one that I've been looking forward to the most. I think this is one of the most unique aspects of F2. You can't go out, at least, well, it's not easy, at least, to go out and just say, I want to buy a nuclear fund, or I want to buy a fund with nuclear exposure. We actually had to tweak the initial version of the FANG index to get true nuclear exposure through it. This is one thing that we had to change in it. There are people out there with a nuclear basket that includes utilities companies like Duke Energy or the Southern Company. But the thing is, a lot of these utilities that are offered up as nuclear plays actually only get maybe 10-20% of their revenue from selling nuclear energy. Most of it comes from, you know, coal, gas, that kind of thing. So one thing that I'm proud of about F2's nuclear sleeve is that we have made sure that it's essentially pure. When you buy F2, that 20% that's labeled nuclear, it's truly, you know, 90 to 100% of the revenue from those companies comes from nuclear energy, from mining uranium, or from, you know, producing nuclear power as Constellation Energy does, and selling it to customers. We implemented, or, you know, in partnership with Bloomberg, who created the index, they implemented a revenue screen to guarantee that all the nuclear companies get most of their revenue from nuclear energy. So Constellation, let's focus on Constellation for a moment, because it has been the biggest driver of F2's returns so far. It's performed quite well. And the reason why Constellation has performed so well is that it's kind of the only game in town if you're a US investor and you want to buy a large cap company that makes money mostly from selling nuclear power. You say those list of criteria, and the only stock I could possibly come up with is Constellation Energy. If you want to go for microcaps, there's a couple other pure nuclear power providers. Other than that, it's basically Constellation. And it gets at least 80% of its revenue from selling nuclear power. It is the largest provider of nuclear power in the United States. And Alex, one of the things that's really lifted CEG stock since F2's inception has been the Inflation Reduction Act. And this is kind of another funny tie-in to the ESG movement. Hey, so sometimes our stocks and funds benefit from the ESG movement. We don't create that situation, but sometimes we benefit from it. In this case, the Inflation Reduction Act, meant to sponsor clean energy, included a significant tax credit for nuclear power. And to give you a scale of the tax credit, a $15 tax credit per megawatt hour, this is something that Constellation in the recent past, may have sold for 45 bucks. So it's a $15 tax credit on something that you might have sold for 45 bucks. So obviously a massive boost from the government. And remember, Constellation is, as far as I know, the only large cap company that primarily benefits from that massive tax credit. And so Constellation has really risen on it. Constellation has pulled back a bit over the last couple months. I believe personally that is because the market was pricing in Trump being elected. This is maybe a month or two when Biden was still running. All of a sudden, the market had a week where it decided Trump was a lock to beat Biden. It suddenly priced in Trump winning. Fuel rose, renewable energy dropped, and Constellation dropped along with renewable energy. And my theory is that the market woke up and it had a day where it thought that Trump was going to roll back the Inflation Reduction Act, and it punished everything that act benefited, all those forms of clean energy, including nuclear energy. But I do not believe that Trump or the Republican Party have any interest in getting rid of that tax credit for nuclear energy.
And short-term data points over the long term. This is an investment with broad secular tailwinds, deglobalization. Short-term stuff really irrelevant. Performance of this fund and of the sectors should be great over the long run.
Yeah, and on the theme of deglobalization, the nuclear category really has powerful ties both to deglobalization and to AI. So let's talk about the deglobalization part first. So Alex, kind of a dirty secret in the nuclear industry is that it still runs through Russia. As much as we hate Russia and we say bad things about it, we all have to remember, we still get uranium that runs through Russia and the Russian partners. And that is a problem. Russia, I think, still controls something like 20% of the uranium mining and refining supply chain, and fully 50% of the uranium mining supply chain runs through Russia and near Russian neighbors like Kazakhstan. And so nuclear energy has great promise, and I think both parties are agreeing it has great promise to provide clean and reliable, efficient power. But to wean ourselves off of Russian energy and Russian uranium, the United States government is really trying to support and encourage nearshoring and onshoring. So our Canadian friends like Cameco, who mines uranium, the U.S. government is offering more and more support for these companies.
That's great. Let's get to our last letter, G, for gold and precious metals. Now we look to see a bit of a mix here between gold and copper in the future. Why don't we talk about that?
Yeah. So this is one of the things that I was more surprised by and interested in it when coming across it in our research. It started as a simple question. Hey, what is our precious metals exposure? How much of it is gold? I was actually expecting more of it to be silver. You think gold, silver, and you expect whatever's third to be a distant third. But in fact, 25% of our exposure at F2 currently is to copper. And our copper exposure is growing at a faster rate than our gold exposure. So I expect that it will gradually compete against gold over the course of the next decade. And copper, when I looked into why our copper exposure is rising, there was an interesting story behind that. And it's basically that all the miners, even the biggest gold miners in F2, are starting to diversify revenue streams into copper, because copper is a good conductor of electricity. Gold is shiny. Everybody knows why gold is good. Gold is good because it's shiny. Copper, not quite as shiny, didn't like it quite as much for most of human history, but now we're realizing that copper conducts electricity really well, which makes it a crucial metal in basically most modern technologies. Anything that uses electricity or wants electricity to go from one place to another, batteries, solar panels, renewable energy technology of various kinds. So the batteries that are used in EVs, it's used in semiconductors increasingly. NVIDIA is using copper in its new interconnect between its chips. So those are just some examples of how copper is being used in more and more things, more and more technologies.
Oh, that's excellent. Therefore, another secular tailwind at the back of this sector, making up 1/5 of the fund. Corey, can we go to the last slide or second to last slide and talk a little bit about FANG 2.0? We're running up here on time, and I want to ensure that we have time for some Q&A. You can see here the ticker, the QSIP, the expense ratio, all of the disclosures that our friends in compliance mandate that we inform you of. You can see our top 10 holdings. You can see that Constellation's big run has led to an outsized position. Deere, Exxon, Freeport McMoran, spanning all 5 sectors. I guess I'll end it with this, Chris. You know, deglobalization has some long secular tailwinds behind it. It makes it really exciting, not just as a fund for us to talk about, but as a theme that's going to promote, you know, America first and American capitalism. Some of the characteristics that would benefit deglobalization are heightened geopolitical risks, persistently high inflation, specifically coming off a zero bounded rate where we've lived for much of my career here in the industry. What are some other characteristics that would lead for this onshoring or nearshoring, that would lead to the need for security, chip security, food security, energy security, and of course, national defense security?
I think that you can really sum it up in 2 words with first, China, second, a distant second, Russia. And, you know, there's a straightforward trade-off. And this is related to the inflation sub-theme, which is that countries benefit from letting each other be involved in the supply chain, doing what they're cheapest and best at. It's called the theory of comparative advantage. And so that's how you end up with lots of really cheap goods that these companies sell and really global, gnarled supply chains. And then, you know, part of what woke us up to the risks of supply chains was the pandemic. When the pandemic happens, everybody's like, wait a second, my entire company is shut down because some widget got stuck, you know, in a shipping container in San Francisco. And so the pandemic alone was a force for deglobalization, but really the larger one involves China. And I would say this is even larger than Russia. You know, the world's 2 largest economies looking at each other, looking at Taiwan, thinking, are we going to go to war? We don't want to go to war, but people rarely do want to go to war. And so one of the steps to kind of make them each rely less on each other is to decouple those 2 economies. And China has been functioning as the world's factory for decades. So that causes massive ripple effects. So in our move away from Russia, particularly Europe's move away from Russia, that really affects FANG 2.0 through the fuel sector, fossil fuels and nuclear. But if you want to talk about deglobalization generally, then, you know, the 800-pound gorilla is China, and how basically every industry is trying to extricate itself from the Chinese market.
Absolutely. Well, that's a great synthesis and overview. Thanks. Corey, it looks like we have quite a few questions here. We can put up our disclosures while we take them. All right, question number 1. Can the U.S. truly deglobalize its energy demand with current policies in place?
That's a good question, and I'd say it's a matter of degree. There are some policies, including some bipartisan policies, that can really help. And it's the nuclear sector that has kind of the fewest obstacles from the government. And really, the government lately has been lending more of a bipartisan helping hand to the nuclear sector. Let me give you a couple examples. In addition to the bipartisan Inflation Reduction Act and its nuclear tax credit, there was also the recently passed ADVANCE Act, which makes it a lot easier to build nuclear reactors. Part of what the ADVANCE Act does is it literally rewrites the mission statement of the Nuclear Regulatory Commission and says it's part of your mission to enable nuclear energy, to make sure it's offered, not just to make sure it's safe. And another example of a recently passed bipartisan act was the Prohibiting Russian Uranium Imports Act. So Republicans and Democrats managed to agree on that. So to break up the question, can deglobalization of, say, the energy industry take place under current policies? With respect to nuclear energy, yes. Republicans and Democrats are both realizing that they don't want to fight each other over nuclear energy anymore. They're actually realizing they both like it for their own reasons. Now, in the case of fossil fuels, current policies can often be a problem. And to give you one prime example of this, the Biden administration is kind of torn between a rock and a hard place. Every time, Russia invades Ukraine, oil prices spike. Everybody's saying, Biden, bring inflation down. He starts offering a few more permits for, more drilling and stuff like that. And then inflation comes down and then people say, Biden, why are you allowing drilling? Why did you allow those permits? And so then Biden says, okay, I'm going to hold up some current permits that are in process to allow LNG export facilities to ship natural gas from the US to Europe. So that's a prime example of a current policy in place that is really stopping us in the energy industry from benefiting appropriately from deglobalization. Alex, US producers of natural gas have an arbitrage opportunity. They have an opportunity to essentially produce natural gas very cheap for a very low price here in the US and then sell it much higher to Europe, because Europe was Russia's biggest customer for natural gas. And so it's eager and happy to buy all the US gas it can to replace it. But in order for that to happen, we need to be able to liquefy this US natural gas and export it to Europe. And the construction of those new terminals is oftentimes halted at this very moment because of Biden's recent move.
Absolutely. So the constraints of the ESG movement, we talk about the ESG constraints, the politicized ESG movement's constraints on American companies, one of the things we push back against. I do see a question here that pertains to that. Do you think that ESG constraints might loosen as the demand and cost for copper continues to increase and we look at these sectors expanding?
This is a really great question, Alex. And before I answer directly, let me kind of point out the absurdity of how the ESG movement wants copper, but doesn't want it to be mined. So there's a few things I have to explain here. So the first piece I've already told everybody, which is that the green transition relies on copper to conduct electricity and batteries and EVs and renewable technologies. They need copper. Yet, the part that I made a note on but I haven't explained yet today is that the ESG movement as a whole views the metals mining industry as a kind of ESG villain. And why are the miners bad guys? It's because of something called Scope 3 emissions. It's a complicated regulatory topic, but to really distill it to its essence, Scope 1 emissions are just your emissions that you as a company produce doing your business activities. So totally normal. Scope 2 are basically, your supply chain's emissions too. Scope 3 emissions include all the downstream emissions of your products by your customers. And this is one of the main things Strive opposes in our corporate governance. So Alex, if you drive to work, you using that fuel, I'm assuming this is not an EV, you using that fuel adds to Exxon's Scope 3 emissions. And the fact that the car you drive in is made of metal when you drive it and use that fuel means that you're adding to the miners' Scope 3 emissions too.
Sounds like a bunch of mental gymnastics that is likely the byproduct of bureaucracy
Yeah, and so
political theater.
it's a funny thing about the way these things are calculated. Uh, the environmentalists succeed in making Scope 3 emissions a concept that people want to reduce, and they say, okay, let's reduce all the Scope 3 emissions. Well, through the definition of Scope 3 emissions, all the uses of your products, basically, when miners produce metals, and those metals are turned into products, any emissions those metal products cause are blamed on the miners. And they say, oh, miners, you need to cut your Scope 3 emissions. And so we have a really weird situation. For the ESG movement, part of it house, we need more copper so we can have our green transition. And another house, we need the copper miners to lower their Scope 3 emissions, which requires less metals. So it just needs to make a call and figure out which it actually wants.
As my kids like to say, make it make sense, Dad. Look, we can go on ad nauseum, as you can tell, highly passionate about this topic, but I am being told that we need to wrap up. For more information about the Strive Natural Resources and Security ETF, please visit strivefunds.com. If you're a financial advisor or institution looking to learn more about Strive or any of our investment products, please reach out on that website. Chris, I want to say thanks so much. This was so fun. I wish it didn't have to end, but all things do come to that point. Thank you all for spending some time with us. My name is Alex. This is Chris. We appreciate you.